Good morning, Hadi, and thank you for inviting me to participate in your with your team.
Well, you're very welcome, and I really appreciate you, kind of coming over every year. We ask you to please participate and give us a heads up of what's going on. So a lot of people are wondering what you're thinking is happening in 2023 and beyond.
Thank you very much for inviting me, and certainly the market condition in the third quarter of last year was quite difficult, and the fourth quarter was quite painful. Last year, at the beginning of the year, things were actually moving fine, and then things became really very difficult. So last year, beginning of last year, 2022, exactly this time, mortgage rates were still at around 3%, as we all knew. Once in a lifetime opportunity, multiple offers were still prevalent, and home inspection waivers, all that situation. Then things began to slow down a bit in the second quarter. Not bad, and some people actually welcome because multiple offer is not a healthy situation. There is only one winner with multiple losers, and you have to start the process all over again if you didn't win the bid. So it was somewhat welcoming in the second half that the demand somewhat cooled off, and the demand cooled off because of two reasons: higher prices and higher mortgage rates. But the third quarter became worrisome, ugly, but fourth quarter extremely painful. At least the data is showing the decline in home sales around 30% from 1 year ago. So imagine transaction activity falling off 30%. Now out in the Wilmington, North Carolina, the decline has been actually holding on. Decline has been less severe. Perhaps this work from home situation. I am here in Washington, D.C. The streets are still fairly empty. I mean, traffic jam is beginning to slowly develop, but nothing like pre-COVID 2019 conditions. Pre-COVID, it was a nightmare traffic jam, but the fact that we don't have that is implying that there is some degree of remote work, which means, hey, why don't I have a remote work in a nice location? Wilmington, North Carolina, Asheville, North Carolina, and certainly people with family members near Charlotte area would say, yeah, I want to be in the Charlotte area. So I think this remote work situation, which is still ongoing, is helping some of the resort destination in the more affordable regions. But the fourth quarter, nonetheless, sales were down about 30%, 35% from 1 year before. Wilmington, I think they were down maybe 25%. But the prices were still substantially higher this past, say, December, November, compared to 1 year before in the regions that Hadi oversees. The Carolinas, the Charlotte, Rock Hill region is still up about 9%, 10%, 11% from 1 year ago. So despite all the headline about housing market crash or housing slump, your client are doing quite well. Your client, the homeowners, are saying, thank God I purchased my home with my realtor at 3% mortgage rate, because if I had to re-enter the market now, perhaps I cannot purchase. So one of the things that you may want to do is recontact your clients just to say hello, and you are the best in terms of what kind of language to use, because they are happy. We look at the data on homeowners. They have seen a rise in housing wealth from rising home prices. They locked in those low monthly payments, and we have a historically low foreclosure rate. Low foreclosure rate, people are not in distress. Homeowners are quite content. Your clients are quite content. And you want to associate that homeowner happiness with what you did. I mean, your service provided that happiness, because most of the future clients are coming from referrals and recommendations and repeat clients. So you definitely want to be in that presence of their happiness that they feel. Now, the market has been chopped off, as I mentioned, from rising mortgage rate throughout last year. But there are some hopeful signs that is beginning to develop. Hopeful sign is that mortgage rate which peaked at above 7%, I think 7.1% average rate of 7.1%, late October, early November. Today, it is closer to 6% with a possibility of going under 6% very, very soon. So this means that some buyers who simply got priced out from higher mortgage rate may begin to stir with some interest to say, I don't think 3% will ever return. And I don't think so. I mean, personally, I just don't think that it will happen in my lifetime again. 4%, I think it's still going to be quite a challenge to get to 4%, but 5% will be good rate, or even 6% will be good rate. Now we are approaching 6%, and there will be some stirring of interest among people who got priced out at 7%, beginning to reconsider. So a little hopeful sign that mortgage rate had begun to decline in December, and here in mid-January, mortgage rate close to 6%, and I think by spring buying season, possibility, not a guarantee, possibility of going under 6%. Now here's why. The reason why mortgage rate will be a little better is first, inflation appears to be coming down. You go to grocery store, still everything is expensive. You want to buy eggs, price of egg is I think up 60% from 1 year ago. So some items are really costly. But nonetheless, the Federal Reserve, whose job is to contain inflation, are beginning to notice that inflation is less strong now than before. Summer of last year, inflation was hitting 9%, but now lately inflation is hitting 6%. It is still high, but it is trending in the right way, because the desired goal is about 2% inflation to be the desired goal. And slowly we are moving towards that direction. One of the big contributors to decelerating inflation, meaning calming the price down, is first, the oil prices or the gasoline prices are now about the same as 1 year ago, no longer rising. It is still high, but at least it's stopped rising. Second part is that the rent growth, if you are real estate investors or you serve real estate investors, you know how well they have been doing. Not only about collecting rents, but the home prices. So real estate investors have done well, but because of high rising rent, apartment building has been super active. So we are beginning to see large number of apartment in the pipeline that will reach the market. So once this apartment begin to reach the market, it will tame the rent growth, but also at the same time, it's going to help on the consumer price inflation, which means that the Federal Reserve does not have to be so aggressive. Federal Reserve will raise its interest rate 1 or 2 more times, but that's not going to change mortgage rates, because mortgage rate, people thought the mortgage rate and the Federal Reserve will be even more aggressive. So the fact that the Federal Reserve is becoming less aggressive is implying that mortgage rate has already peaked and it could go down. Now, there is something very unusual happening in the mortgage market currently, and it's the following. I'm here in Washington. Hadi participate in large brokerage group that we have meeting and the mid-year meetings in May and the annual meetings. So Hadi appears and give us his input, and we share some information. And one of the strange things that's going on related to the mortgage market is that we advocate, NAR, 1.6 million members, we advocate and have been advocating to say that American middle class, hardworking Americans, if they are working hard, middle income persons should be able to buy a home. So in that process, we advocate for essentially government guarantee on most mortgages that are originated. Consider a mortgage that was originated by Bank of America, well, that eventually gets sold over to Fannie and Freddie. FHA mortgages, essentially government guarantee. Veterans, zero down payment government guarantee mortgages. So there is large degree of government guarantee within the mortgage market, and it's not a subsidized market. It's a self-fulfilling market. They earn some fees, and any foreclosure they're easily able to pay off. But the idea behind this is to say that if U.S. government has to borrow money, and believe me, U.S. government is borrowing a lot of money. I mean, there is actually a debate in Congress a few blocks from here about the debt ceiling limits and so forth. But to say that if the U.S. government borrows a certain interest rate, American middle class to buy a home should be only a little bit larger. So to give you an example, if the US government borrows at 3%, then American home buyers should borrow at 5%, just a little above. So based on the normal spread between what the government borrow and the mortgages that have government guarantee, like Veterans Affairs mortgages, the gap between the two interest rates should be very, very small given the government guarantee. But back in December, it was extremely large, extremely large. Put it simply, if we had a normal spread between government borrowing and government guarantee mortgages, today's mortgage rate should be closer to 5.3%. Can you imagine your clients if they were to see a 5%, 3% mortgage rather than, I think it was 6.3% last week? So if we can just get back to the normal spread, then it would be much, much better for your potential buyers out in the marketplace. Now, why do we have this large spread? Well, people can come up with many ideas, but one thing that I can say is that this large, unusual spread between government borrowing rate and the mortgage rate is rare occurrence. It happened only 2 times during the past 30 years. One occurrence was back in 2008 when Lehman Brothers went bankrupt. That's a Wall Street investment company. It went bankrupt and it caused a huge panic in Wall Street because of the bank run. Your money was safe. You remember FDIC in your bank to say your money is safe even the bank goes under? So your money was safe. But the banking system, whether Goldman Sachs, Chase Bank, and others, they were really panicking if they will go under because all this derivatives and other part. So we had that unusually large spread, but after 6 months, it disappeared. The second time we had a large spread was back in March 2020. When ugly COVID came to the country, nobody knew what's going to happen. So there was a large spread, but then large spread again disappeared after 6 months. Back in November, December, we had a large spread. What is the reason? We don't know. And people are saying, well, why is there a large spread? But one thing we do know is that large spread is unusual and usually it disappears in a 6-month time frame. So by spring buying season, if we have a normal spread, again, spread meaning government borrowing interest rate and what the mortgage rate would be for all the government guarantee mortgages, you are looking at mortgage rate of about 5.3%. So that would be hugely helpful in getting the buyers back. And long-term mortgage rate average is about 7-8%. When I first purchased home, and I think many of you will remember your first time experience, is that it was not 3% mortgage rate or 4%. When you first bought your home, it was much higher. Mine personal was 8.5%. But it was one of the best decisions that my wife and I made because that was the path towards wealth building steadily over time. My parents, who live actually a few miles down the street from Charlotte, they purchased their first home in Columbia, South Carolina, a little outside of Hattie's area, but we visited Charlotte many times, just 1 hour drive from there. So they purchased their first home at 15% mortgage rate. It was one of their best decisions ever when they purchased, way to build wealth. Because there's something great about America. Not only about this mortgage system to assure that American consumers borrow only a little bit above what the government is borrowing, but the fact that we have the opportunity to refinance. Mortgage rate goes up, mortgage rate goes down, and when it goes down, you refinance. My parents were not stuck at 15% mortgage rate. They refinanced a few times. Same for me. I was not stuck at 8.5%. I was able to refinance downward. So someone who is getting into the market, say today, facing 6.3% mortgage rate, they may say, well, is it a right decision, not right decision? when the mortgage rate goes down to say 5% or even in the 4.5% range, I don't know if it will happen in the next couple of years, at least it gives them the opportunity to refinance down. If the mortgage rate does not decline, then pretty much they got it in at pretty much cyclical low point. I mean, it's not a super low point, but still reasonably low point condition, given that historical average of mortgage rate is around closer to 8% range. So mortgage rate, if your clients can qualify and find that right property in the marketplace, certainly they always have the opportunity to refinance. So one good news as we are approaching spring buying season is that I believe the mortgage rate will be lower. That will open up the gate somewhat, not a massive number of buyers coming in, but some degree of buyers coming back to the market. So at least the home sales, I think, which has been bleeding and bleeding and bleeding, will stop bleeding and may begin to turn upwards in the spring buying season conditions. The other part is the job market. People are talking about recession. Are we in a recession? Are we going to go into a recession? Ignore that. I think what's more important is jobs. Your clients has a job, then maybe they can buy a home. Right now, we have historically low foreclosure rate because even though there are some industry where they are laying off workers, maybe Bank of America will lay off workers because banking system, I think they're having a little lower profit level, so they may lay off workers. The mortgage industry has certainly laid off workers, but of each one layoff, there's actual job creation in the other industry. And people may say, well, those jobs are out in the main street, cashier job, working at 7-Eleven or something like that. Yes, those jobs are available, but if you look at the income of those people who are finding job, it closely matches of people who are losing job. So as a country as a whole, we are not in a job loss situation. We are in a job creating environment. So whether we are in a recession, we're going into a recession, we're still creating jobs. And very good news for the North Carolina, South Carolina market is one of the faster job creating areas. So Charlotte region, Rock Hill region, in the Asheville, Wilmington, they're certainly benefiting more the resort type along with the retirement. There's a growing retirement population. So given that condition, you have other positives. So you have falling mortgage rate, which I think will happen, not a big decline, but at least it's moving in the right direction. And then you have this continuing job creation. I'm in Washington, I mentioned a few times, and job condition in Washington is still below pre-COVID, meaning that total number of people with job in DC area is actually below what it was pre-COVID. But Charlotte, way above. Wilmington, way above. Asheville, way above. So again, you have more jobs, and that will be a supporting conditions. One concern that I have on the marketplace is the limited inventory. Now, I know you have some sellers who are saying, well, I'm not finding buyers. So homes are staying on the market a little longer, but homes are staying on the market longer because buyers were choked off from higher interest rates. But now that the interest rate is falling, there will be some degree of return of buyers. Buyers will return to the marketplace. So as they return, they will face the same dilemma as what they faced last year. Where are the homes? I don't see many choices. I want to see 10 homes before making an offer, but it is still the case that when you see the home, there's not enough supply. I think the month supply situation, according to the Canopy Association of Realtors in the Charlotte area, is showing that month supply is only around 2 months supply. I mean, 4 months would be considered somewhat tight market, but 2 months is still tight. It's not the 1 month's supply that was the case with multiple offers, but it's still reasonably tight market condition, which means that people who are buying today should have less concern about any potential price decline. I don't, given the limited supply, prices generally do not decline when there is a limited supply, but also in case there is some temporary price decline, I would just simply say that's a buying opportunity. Because Charlotte region, even with a strong run up in home prices, You compare that to Washington, you compare with Boston or especially the California market, it is still very affordable. And I think that's the key reason why you are seeing many newcomers come into North Carolina, come into South Carolina because of the affordable conditions. And just as an example, when San Francisco residents sell their home, wherever they go, they're buying the property in Tennessee, North Carolina, all cash. Because that's how much they're bringing into the market. So I would say the risk is really about the lack of supply, not enough supply to match the potential increase in demand from lower interest rates. So something that NAR constantly push for is we need more home building activity. And in fact, the home builders, they have been very cautious this cycle, very cautious, yet they're still making profit. In fact, if you want to say the stock market is a leading indicator for future activity, home builder stocks have really come back nicely in the past couple of months, clearly implying that Wall Street is saying you should be building more homes, you should be building more homes, there's a profit opportunity. So I think that we need to build more home, and I hope the builders do build more homes. I'm talking about single family homes, because apartment, I think we are getting saturated on the apartment side, but we don't have sufficient single family home construction. So to just quickly summarize is that first, home price decline, I don't think will happen given the housing shortage. But if it does, is a buying opportunity because home prices in Wilmington, Asheville, Charlotte, wherever region in South Carolina, North Carolina, 5 years from now, it will be meaningfully higher. 20%, 30% higher than what it is today, despite what may happen temporarily. So that's one. Second part is that the worst in mortgage rate, I think, is over. We saw 7% mortgage rate, very painful condition, but now we are already approaching 6% with a possibility of going down to 5.5% by spring buying season. And the third part is that at least the builders are getting some Wall Street money, or the stock prices are rising. So hopefully the builders become a little more active, and then that will bring more supply to the market. So thank you for listening. And again, I want to thank Hadi for inviting me to participate. And now we have the question and answer session. So
Joined NAR in, I believe, 2000, and you grew up in Columbia, South Carolina. So in your opinion, in the last 22 years that you've been at the NAR and seeing the market change, what is the biggest change that's happened in the last 22 years?
Well, one of the painful experience was about a dozen years ago, 12, 13 years ago, during the foreclosure crisis. Now, we had that foreclosure crisis, people losing homes. It was, very painful situation, but we fixed that. Why was there a foreclosure crisis? First, we had those strange, risky mortgages. Here's a mortgage. We're not going to check your income, either adjustable, and it just self-imploded, and we had the foreclosure crisis. Thank goodness we don't have that today. There is a common sense regulation today to say you have to show ability to repay the mortgage before you get a mortgage. What a common sense. So given that, there's much less of any mortgages blowing up. Only when people lose job, maybe they cannot pay mortgage, but right now we're in a job creating condition. The second part is that, the home builders, I mentioned we need to produce more. Well, we had the housing shortage before pre-COVID. Back, before the COVID came, we had housing shortage. Housing shortage worsened during COVID real estate boom, the first couple of years. But I think we need to constantly be cognizant that, we are still in this housing shortage environment that will not be quickly addressed for at least a couple of years. And hence, again, I think the home prices will be in a very stable foundation.
What are some of the things that the agents that have joined or have been in the market the less than 5 years should be thinking about differently today as far as listing, selling houses that you think we should be talking about as far as the market is concerned? Because a lot of the agents that have been less than 5 years in the industry are not familiar with this market. and they're scared. They say, oh my gosh, what are we going to do with the 6% interest rate? Because they haven't seen anything but 4% interest rates and multiple offers and so on. So what would be your advice to those agents?
I admire every one of you, to say that you are a self-starter entrepreneur, small business, running your own marketing campaign. And what we see in the data is that it is super competitive market out there, not only among the agents, but within the brokerages. It's a super competitive market. And when the market tide is lifting, when there's increased home sales, certainly provides business opportunity, but it always goes back to the fundamentals where even in a down market, you still have a 20% of the agents who still do well even at a down market. Up market, of course, you have more people participating in the growth, but because everyone is doing their own business marketing campaign, the circle of influence of people they influence, again, most clients are coming through their referrals, recommendation, repeat clients. So it's all about serving your client's best interest over the long term to get that referral. But I think given the run up in the Realtor membership over the past couple of years, there will be some degree of shakeout that occur, especially what happened late last year. It takes a little time for the membership to drop, but I think there will be some decline. And the other part is technology. Embrace it. It's here. There's no way to prevent the technology from progressing. Your clients are doing more individual homework, searching on their own. But then once it's time to see that property, all the association that goes with the complexity of home buying, your counsel, your advice, all that will be critical, but there is more technology and initial homework that is done by the consumers today compared to say 20 years ago.
As far as iBuyers, institutional iBuyers and institutional buyers, what do you think is changing in that market, and what do you think the future of that is? Because I know a lot of them stopped, some of them actually totally stopped buying homes. And so what do you think about that?
So that's another competition into the marketplace. But I think the iBuyer model is very difficult today because it depends on buying and later selling at a higher price quickly. But I don't think prices will rise quickly. I think the prices will remain stable this year, mostly stable, and then maybe begin to go back to the normal appreciation of 4 or 5% a year. But the iBuyer model assumes you can do a quick flip. And only way to do that is either buy on a super discount. So I think you need to also relate to all the home sellers. Yes, there is iBuyer model out there, but they're trying to pick up that property on the cheap. So, be mindful of that. But I think that most clients will understand that, working with a realtor that can get much higher value rather than through iBuyer process. But it's another model, and I think the iBuyer companies will have struggled through a bit out there.
And finally, where do you see the market this time next year?
So this year, when I look at the data, mortgage rate is coming down. So home sales are going to steadily pick up compared to what it was in the fourth quarter condition, even after seasonal adjustment. But we cannot really match the first half of last year. First quarter 2022, second quarter, those are high figures. It's going to be hard to match. So if one looks at the annual total, it will be that this year the sales maybe still be down about 5 to 7%. Again, Carolinas will be better, meaning that maybe your home sales actually hold on compared to what happened last year. But that will be the condition. But 2024, next year, things moving very positively. All the abnormality about the spread in the interest rate, that will be all gone out of the way. So the mortgage rate will be very favorable. And I think the job creation just continues, and especially in North Carolina, where you are getting so many new companies coming in, new residents moving in. You are in a much better situated market compared to other states.
Well, thank you so much, Dr. Young, for joining us this morning. And I think we'll see you soon again. I think next meeting we have in July. I'm sure you get a call from us, and we'll see what happens in the next 6 months. But again, thank you so much for joining us.